Welcome to Mark Arnold's Finance. Today I want to share what I feel are the best stocks to buy in 2023. We're going to be covering 10 stocks, and what I did is I divided this out. I want to go over 5 dividend stocks and 5 growth stocks. And so the idea with these buys are that you will hold them for 5 to 10 years. So you have to keep that horizon in mind as I go over these companies, because some of these might not make sense if you wanted to hold them for 1 year. So I'm going long term, 5 to 10 years out. Now, before we get started, I want to share with you my portfolio performance. We'll see here that I'm in the red, 4.19%. This is where my portfolio has been capping out at with its loss. So it's almost like it's the resistance for this portfolio, and that is creating a $2,000 of unrealized loss. Now, this is real money. These are real holdings. My channel, I want it to be about transparency and honesty. So if you like that type of content, be sure to subscribe and you can follow me along on this journey to become wealthy. And I think it's the best way for you guys to learn as well, is to see someone's actual journey, their path, their strategies, so on and so forth. So be sure to subscribe, and I really appreciate all those who have subscribed to my channel thus far. Now let's get started into this video. I want to start with the dividend stocks, the 5 dividend stocks, and we're just going to dive right into this because there's 10 stocks to cover, and the first one is going to be Johnson & Johnson. Now Johnson & Johnson is down 2.45% year to date with its stock, and we want to first, since this is a dividend play, we're going to be looking at their dividends. We'll see here that this is going to be the lowest yield out of the 5 that I chose, and it's a 2.55% yield, and their payout ratio is a little bit high for my liking. It's at 63%, but you will see why in a little bit when I explain why I believe this is a very safe dividend. And we'll see on the very right, the growth has been above the market median. So other similar stocks in this industry with Johnson & Johnson, Johnson & Johnson is raising their dividend higher. And if we look at that growth, we will see here that their 1-year growth is 6.6% in their dividend yield, in their dividend growth, shall we say. And if we look at the top, just to explain this for the other stocks, the green line is their stock price and the blue bars are their paid dividends. Let's look at their fund analysis. We'll see here that they're considered highly undervalued, of extremely high quality, somewhat low on the growth stability, and then extremely high on the financial health. So overall, these are great numbers. And on that growth stability, I will be explaining at the end why I think that's going to change and they'll become a higher growth company. So if we look at their financial snapshot, we'll see here that their liabilities to asset, that says debt to assets, but it's really their liabilities to their assets ratio is 57.4%. Anything below 75%, in my opinion, is good. Anything above that, I feel you're kind of dealing with some risk that you might want to consider. Now their profit margin is extremely healthy at 74.44%, and their cash flows, this is for the last quarter, the third quarter, you'll see their operating cash flows come in at over 15, almost 16 billion, and they have a negative cash outflow. But you have to keep in mind, this is just one quarter, and you always got to look into it because maybe they're putting some money towards some type of investment or stuff like that. So if it's a company you're considering, be sure to look at the detail. So one reason why I think this company is going to start moving towards higher growth is because they're spinning off their consumer health products into its own company, and they're keeping the medical devices and pharmaceuticals part of their company that have proven to be higher growth parts of their business than that consumer health product. So I think they are going to move towards some better growth over the next 5 to 10 years, which is why I picked this. And the reason why I think its dividend is so safe is because Johnson & Johnson is one of 2 companies that has a higher credit rating than the US government. So I think despite what I feel is a little bit high on the payout ratio and the dividend yield's a little low, I think it's one of the safest dividends. And the other company with a higher credit rating than the US government is Microsoft, just to share that information. Now the next company that we're going to talk about is Cisco. Now Cisco year to date is down 23.27%. This is a networking equipment company. And if we look at their dividends, now we're going to move into dividend yields that are all above 3%. So this company's at 3.13%. Their payout ratio is at 55%. So again, I like to see that below 50, but this is just above that. So I'll take it. And their growth, it looks like they either meet or grow their dividend above the market median. If we look at their dividend growth over the 1 year, it's been pretty small at 2.7%. But again, that yield's above 3%, so at least you're collecting what I consider a healthy yield in a very healthy, high quality company. And if we move to the fund analysis, they're considered highly undervalued, of high quality, they're right in the middle of growth stability, and their financial health is considered high. And if we look at their financial snap, we'll see their liability to assets is very healthy at 56.7%, their profit margin is very healthy at a 63.75%, and their cash flows are positive, and they have good operating cash flows as well. And so with Cisco, I think this company will provide good growth because they're moving their business model more towards subscription-based services, and I think that's only going to help them year over year. So 5 to 10 years from now, I think this company will be highly into that subscription-based model, which will prove to provide some good returns for you and I, the investors. Now, the third dividend stock is going to be one that might be controversial, but it's going to be Chevron. Now, Chevron is actually having an excellent year. They're up 40.87% year to date. And we'll see here with Chevron, their dividend is extremely healthy. We will see that they have a yield of 3.3% and a very low payout ratio of 32%. And you'll see how much it improved from the trailing 12 months when it was 103% of a payout ratio. So that just shows how positive this stock has been performing. And their growth of their dividend is above the market median. And we'll see here over the last year, it's grown almost 6%, which is good. And with their fund analysis, we will see that they do consider it just slightly undervalued. It's pretty much fair valued. On the higher end of the quality, they have high growth stability, and on the high end of the financial health. So if we look at their financials, we'll see here that their liability to assets is very attractive at only 38.5%, and their profit margins are decent at 27.33. Of course, the other companies are higher, but I think it's just part of what this business does, the oil and gas industry. And then their cash flows are very healthy, especially for this third quarter. So with Chevron, what I got to say is oil and gas, we're very reliant on it still. It's still very important, and I believe it's here to stay for at least the next couple decades. So I think for a 5 to 10 timeline horizon, this is a good investment, and you'll get a very solid dividend that I think they'll increase pretty healthily over a 5 to 10 year time horizon. Now, the next company might be the most controversial of all on this list, and I surprised myself, but the more I looked into it, I thought, you know what, this is actually a decent dividend pick, and that's going to be AT&T. Now, you can tell me I'm crazy, you can agree with me, disagree with me, but hear me out first. This stock is only down 0.5% year to date, so it's performing well compared to a lot of other companies in the stock market. And if we look at its dividends, it is paying a very attractive 5.79% dividend yield. Its payout ratio is low at 41%, and you have to keep in mind, they cut their dividend by almost half, so that's going to throw off the trailing PE payout ratio and the past growth. So with the growth, we really can't look at this. We'll have to wait a few more years to see if they grow this dividend, but regardless, you're getting that very healthy 5.79% dividend. And if we look at their fund analysis, this stock is considered pretty much fair value. The quality's towards the high end, the growth stability's right in the middle, and they actually have good financial health. And so if we look at their financials, we see something that I think is good. Their liability to assets, yes, it's a little high at 67.2%, but this company has dedicated themselves to paying down their debt. So I think this number will only improve over the next 5 to 10 years. And their profit margins are very healthy at almost 60%. Now their cash flows, you have to keep in mind, this is just a snapshot, so you have to look more into it, but this is a cash cow machine. You'll see in third quarter, their operating cash flow was over almost $22 billion. And so with AT&T, I see a company that's focusing on reducing debt, which is the most important thing for this stock to grow. And they also have spun off Warner Bros. Discovery, which if you look at their stock, they're suffering. A lot of the streaming companies, with the exception of Netflix, are suffering, losing lots of money. So this was actually a good move on AT&T's part. And after many, many years of bad decisions by management, I feel they're starting to make good decisions, which I think it's finally creating AT&T to be a good dividend play, at least for the next 5 to 10 years. So this one, of course, I'll be interested to hear what you feel, how you feel about it. But let's move right into the next stock. The next stock is going to be Pfizer. Now, this is a biopharmaceutical product company. It is down 8.7% year to date. And if we look at their dividends, we will see here that they have a 3.22% yield and a very low 31% payout ratio, and they grow their dividend higher than the market median. And their last year of growth is 2.56%, so it is a low growth, but you're still getting over 3% yield. If we look at their fund analysis, we'll see that they are considered highly undervalued, a very high quality, a little bit low on the growth stability, and extremely high on that financial health. So let's look at their financial snapshot. Their liability to assets is healthy at 52.4%. Their profit margins are phenomenal at 74.88%, and they have high cash flows. Look at that, $20.685 billion. So with Pfizer, I have to say that I know this is controversial, but during the pandemic and so far, they are the most sought after shot, which means they will probably hold that title going forward, and they have a strong drug pipeline. They have 3 coming out that should be providing billions of dollars of income for this company. So I do think they have a great outlook over the next 5 to 10 years, and it's a stock I think is worth buying in 2023. Now let's move to our growth stocks, and we'll be looking at some slightly different slides, but we're going to start with the first growth stock, and that's Apple. Now, Apple is down 21.89% year to date, so it's had a decent decline. And Apple, if we look at we're going to start with the fund analysis. We'll notice that they are considered undervalued despite many thinking they're overvalued. And I agree with this. I think they are undervalued. They're considered of extremely high quality, and I definitely agree with that. They're one of the highest quality companies in the world. Their growth stability is right in the middle, and their financial health is towards the high end. So for the growth companies, we're going to be looking at profit margins and returns. So with Apple, all their profit margin metrics are all above the industry numbers, which shows the high quality of this company. The same goes for their returns. Again, for a company this big to be this dominant in every single metric when it comes to their profit margins and returns should say a lot. And if we look at their financial snapshot, we'll see here their liability to assets is high at 85.6%. But with a company like Apple, somebody who brings in so much cash, I'm not too worried about this. And their profit margin is healthy at 45.44%. Look at that massive operating cash flow. We see a negative cash flow, but of course this company is always investing. That's what tech companies do. So with Apple, I think you're getting a company with one of the largest moats in the world, a very healthy ecosystem. So they have loyal customers. You buy one product, you're most likely to buy their other products. They are growing their subscription income and their subscription count, which is phenomenal for this company. So even raising their subscriptions by $1 will create massive profit for this company. And I think this is just a future quality growth stock. It'll be around for the rest of my life. So I think buying now in 5 to 10 years, you'll look back and be very grateful that you bought this company. The next growth stock that I am going to introduce you to is Tesla. Now, Tesla is down a massive 55.23% year to date. So I finally think it's starting to show some opportunity for us investors to buy in. And with Tesla, if we look at their fund analysis, we'll see that they are considered slightly undervalued, of high quality, of very high growth, stability, and right in the middle of financial health. So if we look at their profit margins, we'll see here that they're very attractive compared to the industry's numbers. And the reason why is because EVs have taken a hit this year. But Tesla, being that they're a highly sought after product, I believe is really proving to be beneficial for this company. And their returns are a mixture, but overall, they're fantastic compared to the industry. And so with Tesla, if we look at their financials, we'll see a very healthy liability to assets percentage of 44.7%, a good profit margin, and this will only improve, and it's at 29.54%, and I'll explain why I think that will improve. And then look at those cash flows. They're making money, they're bringing in positive cash flows in the last quarter, so that's a great thing to see. Now with Tesla, of course, EV stocks have been struggling this year, so I think that's creating an opportunity, and it's one I'm highly considering. I think there's going to be a continuous transition to EVs. It's happening, and I think that's just the future. I think that the battery costs have been falling upon my research, which is going to be good for margins. That's why I think those margins will improve. Of course, you have government incentives that helps push people to buy vehicles, and Tesla will be more than a car company. Right now, their automotive part of their business makes up 96.1% of their company, but I think that will shrink and other parts will increase. So I think this will be a good diversified company in the future, and I think it just screams potential, which is why I put it on this list. And I think it'll be higher in 5 to 10 years than it is today and could outperform the S&P 500. The next growth stock we're going to talk about is Google, or known as Alphabet, but of course everyone still calls it Google. It is down 35.84% year to date, so a decent downtrend. And this is just the search giant is what I like to call it. So with Google, we'll look at their fund analysis. They're considered slightly undervalued, of higher quality. They have low growth stability, which I think is with the advertisement side of things, which I'll explain in a minute. And their financial health is towards the high end. Now with their profit margins, we will see healthy numbers. They're in line or slightly above the industry average, and their returns are also very healthy, and I believe all these numbers except the last one are above the industry average. So great profit margins, great returns, and if we look at their financial snap, we'll see their liability to assets is extremely low. This is one thing I love about this company. It's only at 29.2%. And their profit margins are extremely high. So that's a good combination to have. Their profit margins are at 60.76%, and their cash flow is phenomenal. It's huge, and these are just great numbers. So with Google, everyone Googles. I mean, I Google, everyone I know Googles. What other search engine do you use, correct? And if you use others, you probably partner it up with Google. Now, this is an they're highly dependent on the advertisement revenue, so that definitely has taken a huge hit, and I think we'll slowly recover and come back to normal numbers over the next couple years. So 5 to 10 years from now, it'll definitely be roaring again and bringing in this company higher profits and revenue than ever. And this is more than just a search engine. They have Google reviews, which a lot of people depend on when they're looking for products and services. They have Google Maps, you have Gmail, their Google email. You have YouTube, which, hello, we're all watching it right now. And then they also have their Google Pixel phone, which I don't think will disrupt Apple or anything like that, but it could be a decent income stream for this company. So Google's, I think, more diversified than people think, and I think it's offering a great buying opportunity in 2023 for a 5 to 10 year time horizon. Now, the next growth stock is going to be Vici. Now, Vici is an experiential REIT, real estate investment trust, and it's up 13.29% year to date. So if we look at Vici's fund analysis, they do consider this stock overvalued. I will say I agree with them if you're looking at a 1 year time frame, but 5 to 10 years out, I think this company is highly undervalued. They're considered of high quality, higher growth stability, and very high financial health. With their profit margins, we will see a company with stellar profit margins compared to the industry average. This just shows the quality of this business. And their returns are a mixture, but overall, this company is investing heavily in properties and stuff like that. So these numbers will improve as those investments start to return revenue in the future coming years. So with Vici, what we'll see here with their financials, they have low debt to assets at 40.9%, extremely high profit margin at 97.03%. I love to see that. And their cash flows are healthy. It's a smaller company, but they are acquiring a lot. This company is in acquisition mode. And so what I think is a lot of their properties are on the Vegas Strip. Vegas will be the world entertainment destination, the number one destination, shall I say, in the world for entertainment for decades to come. And I think that Vici has a unique setup. They own the land. The companies have to take care of the building. So if something breaks on the building, like Caesar's Palace, which is one of their properties, Caesar's Palace is responsible for fixing it, not Vici. So very smart setup of their business. And I think this company is just getting started. So I think you buy now in 5 to 10 years, you'll look back and be very grateful you did. Last growth company and the last stock of these 10 is going to be the one and only Amazon. I love this company. I'm very bullish on it. And it's down a massive 47.72% year to date. I call this the company of many things. So with Amazon, if we look at their fund analysis, they are considered slightly overvalued. I disagree. I think they're undervalued. They are considered of high quality. They're considered a little bit lower on the growth stability, and their financial health is pretty much smack dab in the middle. So if we look at their profit margins, we'll see here the top four beat the industry average, where the bottom four are trailing the industry average. So with their profit margins, what I will say is it's a mix. You have part of their business that is bringing extremely high profit margins, and another that's bringing extremely low profit margins, which I'll discuss in a minute. Now, when it comes to their returns, you'll see that all these metrics are above the industry average, except for the two that I put a check mark next to. And so I really think their returns will definitely improve in the future. Let's look at their financial snap before I talk about my bullish thesis on this. But their liability to assets is a little high at 67.9%. They are cash cow machines, so that kind of helps me be comfortable with that number. Their profit margins are healthy at 52.74%, and I think this will only get bigger or higher and higher. Their cash flows are very healthy. This is a cash generating machine, just like a lot of the others on my list. So with Amazon, they have the cloud part of their business, Amazon Web Services, which I think is going to be a huge part of its profits in the future. This is a high margin business. This is what will help grow their margins. Now, their e-commerce side of things, they're very dominant. They're the number one e-commerce company in the world, but it provides razor thin margins. So that's why it brings down some of those margin numbers. And I think they'll work on improving those over time, but it's the Amazon Web Services that I think people are sleeping on. And this is going to be a game changer for this company in 5 to 10 years. Of course, they're also in entertainment and grocery. They're expanding international. Right now, during the holidays, what do you see everywhere? Amazon trucks. So I think this company, it's just one that I think in 5 to 10 years, you'll look back and say, man, I should have took advantage of that huge dip it went into for a few years. And in 2023, I will be adding heavily to Amazon because I am bullish on its future. I do think this is a high quality company that with their Amazon Web Services, that's going to prove to propel this company in a very massive way in the future. So there are the 10 companies, the 5 dividend plays, the 5 growth plays. I'd love to hear what you think of my picks. Do you agree with my 10 picks? What companies would you add? What companies would you maybe take out of this? I know AT&T will be a stock that might be controversial, maybe even Chevron, but I really think these 10 companies should provide good growth with a 5 to 10 year time horizon. And I know there's many other stocks, but these are just the ones that I am presenting today. So I'd love to hear your feedback. And with that said, I hope you guys have a fantastic day. Be sure to subscribe. Thank you so much for your time. Have a great day.